When your investment data doesn't work, what do? You create new investment data. That's kind of like the Groucho Marx quote. Groucho Marx says, "Those are my principles. And if you don't like them, well, I have others." You got to be careful when you're doing your investing prognosis on folks' investment data. We're going to bag on the Cape here a little bit and Robert Shiller. And I like Robert Shiller. I'm a big fan. This is not to bag on the guy specifically, but just when your investment data doesn't fit the model anymore, people have a tendency to want to change their investment data to fit what they believe will be the model, essentially to keep relevant. I hate to say it like that, but I don't know how else to put it. And I get it, man, 100%. I get it. I mean, I will die on the cross of value over growth. I just will, because that's what I grew up with, man. And when you grow up with value over growth, it's hard to change, especially when you hit your 50s. That's why they don't market to me. They market to the 25 to 44 category, because those people are more susceptible to changing their behaviors for advertising. Anyway, so the same thing happens with the old days of, low unemployment is inflationary, leads to high interest rates. And again, if you're growing up in that economic model, you can't change that because it's just ingrained in you. But what happens is, instead of seeing the data for what it is, saying, well, your data was just incorrect here, they'll change the data to kind of fit this model that they think it has to work. It's too bad, because I think what happens a lot of times is people forget that investing is not a science. It's just not. Investing, always remember this, just like economics, is not a hard science. It's not like gravity. Now, can we actually prove gravity exists? Not to my awareness, but we can all say, hey, look, if I drop something, if I stand on Earth and I drop it, it's going to fall to the ground. Can we prove that? No, at least my understanding is, but we all, that kind of makes sense. With the markets, it's not like that. There's no physics to it. The markets are the unique decisions of unique, irrational individuals who make thousands of discriminatory choices every single day. Should I do this video or that? It's just one, for instance. Should I use this pen? How should I title this video? This is the fourth time I've done this video because I keep screwing up. All these things, man, they all matter. And this is what happens when investing. People say, I want to buy Tesla. I don't want to buy Tesla. I want to buy Bitcoin. I don't want to buy Bitcoin. All these are based on irrational behavior. Doesn't mean it's wrong. It just means you cannot say it's in a box, this is the way human beings should react. It's stupid to say that. Because human beings, the individual should react the way the individual sees fit for his best self-interest. Now, tomorrow he might say, why the hell did I do that? Well, he thought it was good. Okay, well, that was stupid. And then the following day, say, why did I do that? This is the issue with investing. But we all want to put it in this hard science data as if it's gravity and say it's got to fit this model. So when I was doing my last video on Shiller, he's got the stuff at Yale, and I'm just sitting there thinking that I seen this, and I say, as of September 2018, I now include an alternate version of CAPE, the cyclically adjusted price to earnings metrics, that is somewhat different. As documented in a couple articles, changes in corporate payout policy may affect the level of the CAPE ratio through changing the growth rate of the earnings per share. And what change in the corporate payout policy is, share repurchases rather than dividends have now become a dominant approach in the U.S. for a cash distribution to shareholders. This subsequently may affect the average of the real earnings per share used in the CAPE ratio. A total return CAPE correction is biased through reinvesting dividends of the price index and appropriately scaling the earnings price. All right, so I want to share you guys something here. This is the new one. Let me see if I can't find the old one. Yeah, here we go. All right, so this is the old CAPE ratio. I don't know why it's got 1981 here. This isn't graphed correctly. It might be because I'm using Microsoft data. Not Microsoft, MacBook Air sheets. But anyway, this is in 2009 right here, the CAPE ratio, all right? Or 2007, excuse me. Then we got 2009, and now we have right here where we are today. No, that's in 2000 right there. That's 2000, excuse me. That's 2009 right there, or 2007. So that's 2000, when Robert Shiller became prominent. He says, whoa, the CAPE ratio is in nosebleeds. And then everyone said, "Whoa, he was right, man." So then it fell to 2003, and then it came up here in 2007, and then it fell again because basically people said, "Look, other than this time when everyone recognizes hindsight that this was nosebleed, this time and that was in 1920s, the CAPE ratio had never been so high." I heard 1,000 articles of that to Sunday. And then we come right here, about 2012, 2013, we get the same thing. The CAPE ratio has never been so high other than this time when the market crashed, this time when the market crashed, and this time when the market crashed. Well, here we are now. Again, we're back up to that's the second highest in history, which means it has to fall, right? Well, not necessarily. So this is the excess CAPE and subsequent 10-year annualized excess return. So basically saying, this is the excess CAPE ratio and subsequent 10-year annualized rates of returns. It's tough to actually plot that on this spreadsheet because it doesn't flow nicely. Anyway, so I said, okay, that's interesting. But then he's got this new CAPE, and we're going to go into this right here. This is total return CAPE. All right, you're like, that's great. So that somehow reinvests the cash flow, and I'm like, wow, that was weird. That wasn't happening to begin with. All right, so then I say, okay, but then he issued a new CAPE. And the new CAPE is the excess CAPE yield when you take in the fact you put in the treasury bonds. All right, so to answer that, let's look at the recently introduced excess CAPE yield for the S&P 500. It's the S&P's average earnings yield over the past 10 years minus the real yield adjusted for inflation on 10-year treasuries. Should have been doing that to begin with. In human language, it shows you the premiums you earn by investing $1 in stocks versus supposedly risk-free bonds. Here's what it looks like today, and that's in December. Doesn't look so expensive, huh? So here's the CAPE in 1926, I guess, 1929. Here's the CAPE in, it's hard to follow. But anyway, that looks pretty normal, doesn't it, when you factor in the 10-year treasury, which was my whole point. The same market isn't highly valued at all relative to the historic trends on bonds. And if you look at the previous CAPE, though, let's see, I think he's got on here. That's not the CAPE. That's just the, maybe he doesn't have the CAPE. There's Schiller right there. Is this the CAPE? Yeah, right here. All right, so right here. As I showed subscribers, the ratio signals the stock market's been more expensive only once in history. Here's the CAPE today. And here it was in 2000. And here it was in 2000 right here. In 2007, oh my goodness, it fell. But here is right back here in 2013. You missed that huge run right there. The dot-com bubble. And so you're like, oh my goodness, look at the CAPE. It's predicted. Oh my goodness, 1929, it predicted. 19, whatever that is, 30, probably 3, it predicted. 1966, it predicted. 1999, it predicted. Well, did it really? Because at the end of the day, we're still well above where we were, even having to deal with all that stuff. Anyway, so it's the second highest it's ever been. But if you look at it from a factor of the interest rates, it's not so high. And so this is excess CAPE, which takes interest rates into being. So all the people who use market, and I read the data at Easterling. I remember reading it, probable outcomes. You looked at CAPE, and I remember this is in 2011. I was like, whoa, man, market's way high. It's only second to where it was in 2000. That might not be good. But I said, well, I'm still plugging. And we go fast forward 10 years, and the market has been on a tear like we've never seen. Anyway, this is the problem I have going back to Schiller. I'm like, dude, again, as of September, I use an alternative vision of the CAPE. A total return CAPE corrects his bias by reinvesting dividends in the price index. But that's not even what he's doing right there. What he's doing here is he's saying, look, dividends aren't the big driver of cash distributions to shareholders. They're buying back stocks as opposed to giving dividends. And so as I'm sitting here, I'm sitting there thinking, okay, earnings growth plus year over year plus dividends. Well, dividends are 2, earnings growth year over year, but that's still reflected in the John Bogle thing. Earnings growth is part of lower shares, higher earnings growth, even if it's a lower dividend rate, if that makes sense. But if you're just looking at it from a CAPE ratio specifically, or even a PE ratio, you're missing something because you're missing the fact that your competing investments are low, or the bonds in that case are priced quite high, where the yields are low. anyway, so you just, man, the investment data, earnings growth year over year plus dividend yield. That's what you should go with all the time. It cannot be finagled. You can't say I'm going to change it. You say, okay, my dividend yield is my dividend yield. That is a fact. My earnings growth, other than accounting shenanigans, is my earnings growth. And if I buy back shares as opposed to paying a dividend yield, that is going to increase my earnings growth. That's just a fact. Well, potentially, it could go the other way if we have no earnings, but still, at the end of the day, that's what happens. Why? Because we're reducing the number of shares outstanding. Anyway, that's why you just got to go earnings growth year over year plus dividend yield. The problem with earnings growth year over year is like, well, what do I predict is going to be? Well, that's no different than saying the CAPE ratio or saying all these other metrics that people use to extrapolate for forward progress. We just don't know. So at some point you have to say, I think the earnings growth year over year will be this or that, and the reasoning is this or that. High government, low government, whatever. But anyway, hope this helps. Like to hear your thoughts. I know this might seem like a little bit of an odd thing, but man, the investment data, it just leaves a lot to be desired. Thanks now.